A friend of mine asked me recently how could he earn risk-free 8% return on his investment. Yeah, and you want to win the lottery too. But maybe there is a way to achieve this and not losing all the return to inflation. Intrigued? In this video, we'll look at what are the asset classes and what are the investments that you can make that can give you roughly 8% as a long-term return. And I'll give you concrete examples for each asset class. Ready to stop going to the casino? Hey there, my name is Greg. I'm a master coach, but I'm also an investor and I've been managing my own money for quite a while now, and I've made probably all the mistakes that anyone can make about money. Here I focus on giving you personal finance coaching so you can make the decisions that work for you. I'm sure some of you have heard the term risk-free and said, well, come on, there's no such thing as a free lunch, there's no such thing as risk-free. Well, let's come back to the definition of risk first. Here we'll take a definition that is focused on financial risk. Risk implies future uncertainty about deviation from expected earnings or expected outcome. There are two key words here, and the first one is uncertainty, which basically means not having data, not having the understanding of what will happen with an investment asset. Risk is first and foremost linked to whether you have the information, the data, short, mid, and long term that allow you to understand where an asset will land. If you have 100% of all the information available, then there is no risk, though it's pretty much impossible to get to 100%. The second keyword is expected returns. The higher your expectations will be, and usually the less the information will be available for what you're trying to achieve. And the counterpart of that is that usually if you have no expectation, then there's no risk. One of the ultimate risk-free investments that you can make is then to invest in the total world stock market. There's no choice to make because the total stock market is representing all the information translated into stock price for the entire world. You're not choosing anything, you're not deciding to be in one geography or another. And there is only one world, at least at this point. In the mind of most investors, the most risk-free investment is government bonds or sovereign debt. This is a government debt that countries issue to be able to pay for whatever they want to pay in their home country. Government bonds have not been having a good time for quite a while now. If you look at the returns of the Vanguard Total Bond Market Index Fund ETF, you can see that investing money there over the past 15 years would actually have lost you money, and that is before considering inflation. If you look closer at the picture though, you will see that there is a window of opportunities that tend to happen when the interest rates in the world are going up, like right now. But that won't last very long if the Fed or the ECB decides to reduce their rates. The Fed is for the US Central Bank and the ECB for the European one. So I think right now we might have about 2 years max. Another way to do this is to invest in countries which have specifically high yields. I've picked 4 for you, and it's tricky because you have to balance a number of things to get it right. The first one is a yield. You want a good yield, but at the same time you want to make sure that the debt of that country is not going to go to junk, that they will not reimburse this debt. And finally, you want the currency to be stable against some major currencies in the world like the USD or Euro because you want this debt to be keeping its value. One of the countries is Chile, and you can get about 6.5%. India would get you 7.4%. Iceland 7.5%, and Brazil 11.8%. There are higher yields available out there, but then you get into really risky territory. Let's take a look at corporate bonds. Corporate bonds are essentially the debt issued by companies and which is publicly available to be bought. So having said publicly, not all of this is easily accessible to individual investors. So sometimes you have to look at exchange traded funds which gather an index of different corporate bonds all together. There are 2 factors to consider when you're picking a corporate bond ETF. The first one is whether we're talking about investment grade bonds, which are usually very stable and from very strong companies, or if we're talking about high yield bonds or junk bonds. At first sight you might think, hey, I don't want to invest in junk bonds, that doesn't sound too good. So let's take a look at the investment grade bonds first. Here you can see the yield you can get from the Vanguard Short-Term Investment Grade Corporate ETF VCSH. At 2.91%, that is not great. And if you see how the ETF price has evolved over the past 3 years, not great either. Having said that, I think we might be at a turning point and we might be in a stable position for the next 12 to 24 months here. And by the way, that is the second aspect that you want to be considering when you are investing in corporate bonds. Are they short-term or are they long-term corporate bonds? Now we can move to the Vanguard Long-Term Investment Grade Corporate ETF, VCLT. At 5.17%, we get a much better yield. Though the problem is that when the yield goes up, the price goes down for bonds, as we can see on the price chart. However, we might be at the best time to actually enter into those bonds, this ETF, because we will probably see some stability about this in the next 12 months. Let's take a look at high yield corporate bonds or junk bonds. Here you can see a list with the top dividend rates from some ETFs. Those are healthy numbers, so be careful about how long they have been in existence and the amount of assets under management. Taking one that has over $4 billion under management, the Invesco Senior Loan ETF, you can see a very healthy 8.48% dividend. As the price over 3 years has been fairly stable. If you do decide to invest in junk bonds, make sure that you find a very reliable provider of ETF. I thought they've been existing for quite a few years and have enough assets under management. You like this video so far? Then you know what to do. Also, subscribe to the channel, put the notifications on if you want content like this every week. And for all the links for what I mentioned in this video about investment returns, check out in the description as well as other YouTubers' videos. Another way to find some stable revenues for your investment is peer-to-peer lending. It is basically a system whereby you loan money to other people through a platform that brings creditor and debtors together. It is now a fairly well-established system, having existed for the past 15 years roughly. Though it can still be quite intimidating about which platform to use, what are the risks which are involved, so I would like to recommend a couple of people on YouTube who are doing a very good job about explaining peer-to-peer lending. One of them is P2P Empire, and the other one is Angelo Colombo. One thing to understand is that in peer-to-peer lending, it can be about lending cash, pure cash, or it can be about lending for real estate purpose or some other type of loan. And one of the key points is really to make sure that you do not invest all your money in just one platform. It's important to choose at least 4 or 5 so you can diversify the risk linked to the platform itself. Having said that, there are some platforms which are very stable and very strong and where there are very little loan default. Right now you can fairly easily get 8% return on the money lent, even if you consider default rates. Or if you want to be 100% sure, or as close to 100%, then make sure that you pick up the platforms which have 0% of default rate. And you can see a list of those companies on the screen. Keep in mind that this is a very European view because that's where the market is the most mature and some of the companies have been running around for a very long time. Make sure you monitor how the interest rates from central banks are evolving around the world because this will very much impact down the road what will be the average rates that you can get from peer-to-peer lending. And if you want to know more about peer-to-peer lending, then check out this video. Aside from investing directly in real estate, which we will not touch here as it is a vast topic, you can invest in real estate investment trusts. This gives you access to a lot of real estate choices without having to do the heavy lifting of actually owning a property. REITs can be about a variety of types of properties. It can be about rental, it can be about commercial, it can be in a variety of different geographies, and sometimes it's actually about the mortgages themselves and not owning the property. A note of caution here is that the real estate market is currently in a fairly unpredictable state, and depending on where you live and depending on what you want to invest in, the situation might not be the same. One thing which is very clear right now is that mortgage rates all across the world, pretty much all across the world, are very high. Though if you look at the US, the market has not fallen off a cliff yet. But if you look at Europe, you will see that in many countries, the real estate market is not doing very well. Commercial real estate fell off a cliff during COVID and it's still trying to recover from that time, and it's not really clear if it ever will. Having said that, let's take a look at some of the best performing REIT ETFs in the US. You can see that a few could give you some very decent returns, though are you taking a major risk? If you look at the first one, the Van Eck Mortgage REIT Income ETF, also called MORT, it focuses on mortgages. And not surprisingly, it is doing very well considering the average mortgage rates that there is in the US right now. If you look at the price, it is stable recently, so you do not want to see something like a big financial crisis or another pandemic, as this would devastate the price. But right now, it's pretty cheap. I would say that REITs are probably the most risky investment assets that you can think of if you look at everything we've talked about in this video. It is because of the massive impact that a black swan event like a pandemic or a financial crisis would have on this type of asset. There is one part of the wealth equation that people forget or do not want to look at. This is your cost of living. The amount you can save and the sustainability of the investment that you've made and how they will pay for the future costs in your life are very much essential to understand. And to do that, you very much need to know what your costs are and to keep them in check. Step 1. Do you have a budget? If you don't, then I highly recommend you to do that first. Build a budget. If you don't know what you spend, it becomes hard to plan for anything. Check out this video if you want to know more. Step 2. Take action based on your budget. Decide how much you can save every month and make it automatic to do so you don't have to think about it. And check your costs frequently to see if you're sticking to your budget. You won't get it right at the beginning, and that's okay. You can accept that there will be a period of adjustment, of iteration before you get it right and you have a clear feeling for how much you spend. Step 3, do you understand the inflation that you actually live through for your cost of living? Having a general view which is coming from what you watch on TV or the newspaper is not good enough. Don't be a victim. Monitor the main categories of costs that you have in your budget so you make sure that frequently you can see whether they're going up or down. And I bet over the past year they've been going up quite a bit. Step 4, learn to adjust progressively. There's usually an awful lot of things that we don't need, but we do tend to consume just for the sake of consuming. So it's important to review this when you see that you have inflation. How can you keep your costs down? You can make it a fun family or friends activity to actually understand how can you save on things. How can you quit on buying a new iPhone every year, for instance. And at the end, if you've saved a lot, then you can reward yourself. But not with all the money you just saved, yeah? If you want to learn more about how to manage your inflation, check this out. You remember the definition of what risk-free means at the beginning of this video? This video is aimed at you people who don't want to be spending all your life looking at information about investment. If you're ready to put more work in about understanding asset classes, about understanding specific movements of those assets, then you can aim for higher returns. Because the more you understand, the less risk there is. For those who would like to understand more about what asset classes there are and how they can invest in them and how they're behaving, you might be interested in this video here.